ready? You got me running, you got me running, got me running. Shake it, shake it, shake it, baby. Raise your hands up, raise them up.
It is Friday, everyone, and welcome and hello to all the people watching us live with the LCMS Trader Club members coming in as well. Welcome. Hope everyone had a good session last night. If you were trading, there are a couple of news releases as well that will be discussed very shortly with Kim Hong as well. But if you are watching this on YouTube and you're looking to find out what this is all about, this is the LCMS Traders Club, and we do present the daily currency call every Monday to Friday at 11 a.m. GMT +8. And a quick introduction as well. We present this call and we do that as follows. So Monday, we start the week off with the Aussie and Kiwi analysis. Tuesday, we do the Euro. Wednesday, Pound. Thursday, Yen and Gold. And then on Fridays today, we've got the CAD and cryptocurrency. And we'll also be going into detail with Kim Hong here about the Bank of England interest rate decision, which was a little bit of a surprise, and also the ECB rate decision as well. A big welcome to everyone that is following us as well throughout the week, and that has been in the chat group as well. There was a little bit of activity last night, which was great to see. And in the currency call, we endeavored to provide market economic updates, the key support and resistance levels with the currency pairs in focus for the day, trade ideas, and of course, much more. And the currency call will be very beneficial to both the long-term investors and also the short-term traders. And we'll discuss, again, possible trade ideas, and they will be discussed in detail with potential targets and risks mentioned as well. A disclaimer, any information shared during this session is not intended to be a trade recommendation. It is solely the opinion and views of the speaker. So please remember to do your own analysis prior to entering into any trades. So from that, we do have a little bit of activity to discuss with what happened yesterday as well. And Gim is all on top of this as well to discuss Bank of England and ECB developments. So over to you now, Gimme.
If there's one central bank that I have to vote on, okay, for being the most, the one who gives the most surprise, it's hands down going to be Bank of England. All right. So for 2 consecutive months already, they have given us surprises, big surprises. All right. Those that, 1 minute, 100 pips kind of movement. Okay. Like what they just did yesterday. All right. So what did they do? I guess most of you already, well, pretty much know what they did, right? Okay, I think my screen is frozen at the moment, but basically what they did was they actually increased interest rates. Come on, they increased interest rates by 0.15%, okay? So previously they were actually, interest rates was actually held at 0.1, okay? But then right now, after yesterday's meeting, it's at 0.25%. Holy, who would have expected that, right? I mean, everyone were expecting an increased interest rate back in November, okay? But then they did not do it, right? Bailey was like, we didn't say we were going to hike, right? And then in December, especially with this whole, this new discovery of Omicron, okay? The market is pretty much like, maybe the Bank of England is likely going to hold back for a while, maybe until the next meeting in February 2022, okay? They actually did hike in the end, okay? They hiked in the end. So, wait, let me see if my screen is back to normal because...
No, it's still loading, man.
It's still loading? Yeah. Okay, then I'll carry on rambling first. Yeah, so they actually hiked interest rates by 0.15%. Reason being, okay, you guys pretty much may know the reason behind it, okay? But it's just that because of the whole Omicron variant that we are this rate hike is basically employment and inflation, okay? Now that I have my screen back, okay, you guys can see the header over here, bank rate increased to 0.25%, December 2021. Good job, Bank of England, okay, good job. So let's just jump to, actually before that, maybe I can get the, what's that again? Yes, this page. Let me just show you guys the votes, okay, which is, I would say, pretty important, okay. Over here, we see, okay, that the MPC, okay, assets purchase facility votes shows 009, okay, meaning no members actually voted for an increase in QE, okay, no member actually voted for a decrease in QE, and all 9 members actually voted for unchanged. Okay, so this is pretty much expected, I would say. All right, because if they were to make a change in interest rates, okay, in this case, then they're probably just going to hold QE and see how it goes before making any amendments to it. Okay, and then moving on to the second vote, the MPC official bank rate votes. Okay, we see that 8 out of 9 members actually voted for a rate increase. That is definitely like a hands down, like almost everyone just voted for a rate hike. Okay, and then 1 member, if I'm not wrong, the member is Sylvan or something like that. Okay, she actually voted for a no change in interest rates. Okay, so overall, yes, we get a rate hike. Good job, good stuff. Okay, so like I mentioned, the 2 main reasons is employment. Okay, first reason is employment, and then the second reason is inflation. Okay, so I'll be doing several what do you call that, switching from here to there, because the whole BOE statement and minutes inclusive, okay, is quite lengthy, so I probably have to just switch rather than just fine. Okay, so over here we see that at its November meeting, the committee judged that provided the incoming data, particularly on the labor market, okay, were broadly in line with the central projections in the November monetary policy report, it would be necessary over coming months to increase bank rate in order to return CPI inflation sustainably to the 2% target. Okay, so if let's say the whole employment, the jobs market is actually performing as expected, okay, by the committee members back in the November's meeting, then a rate hike is warranted, right? That's what they are trying to say. So just take a look at this. Okay, so how well are we seeing the UK jobs market performing? Okay, so over here it says the labor force survey unemployment rate fell to 4.2% in the 3 months to October. Good thing. While the number of payroll employees continued to rise strongly in November. Okay, so what's so big deal about rising strongly in November, right? Because of this over here. There is little sign in the available data that the closure of the coronavirus job retention scheme, aka furlough scheme, okay, at the end of September, has led to a weakening in the labor market. Okay, so with the conclusion of the furlough scheme, there's actually little change. Okay, well, there's actually no weakening, little weakening in the labor market. Okay, so it's actually a good and smooth transition, I would say, to this whole post furlough scheme, right? So with that, the Bank of England actually felt more confident. Well, maybe after ending this whole furlough scheme, which was actually meant to support the people back when the COVID pandemic actually hit. Okay, it's actually time to end it, and we have little negative impact on the jobs market. So it actually, the recent data actually shows, okay, and moreover, for the month of November, 257,000 jobs were actually being added. Okay, so this is actually a strong figure, all right, coming from the labor force survey, all right. So because of that, the Bank of England just felt that it's good, right? Which is why, back to the previous point, it's actually in line. Okay, the data that's been released in November is in line with what's being anticipated by the central bank themselves, right? So because of that, a rate hike is justified. Second thing, inflation. As you guys probably already know, especially the club members, inflation has hit a decade high in the United Kingdom. Okay, 12-month CPI inflation rose from 3.1% in September to 5.1% in November, okay, triggering the exchange of open letters between the governor and the Chancellor of Exchequer, basically the Finance Department of UK, okay. So there's a, exchange of, I would say, some major meeting, okay, going on between the UK's central bank, okay, the BOE, and the Finance Department of the UK, okay. So yeah, they were actually discussing like, inflation is going so high, so you guys, okay, the BOE, who is involved in handling the whole monetary side of things of the country, what are you going to do with it? What are you going to do? How are you going to respond to this super high inflation, this decade high inflation, right? So, like I said, when inflation rises too fast, too high, one way for the central bank to actually tame down this ever-rising inflation is through a hike in interest rates, okay? So I guess this time around, the Bank of England is already receiving a lot of pressure from the finance side of the country, right? It's no longer like the November's meeting whereby, inflation is high, we don't have to end QE before increasing interest rates. Okay, so we may actually increase interest rates to tame inflation, but in the end, boom, we're not going to do anything. I did not promise you anything. Okay, this time around, things are getting more and more serious, from data, from the government and things like that, more pressure. Hence, it is more likely that I wouldn't say it's more likely. I would say, it's not surprising that the Bank of England actually hiked interest rates, although it was an initial surprise, okay, because of the whole Omicron uncertainty, all right? And you guys already know that, these Omicron cases in the UK has been rising, just like how Delta initially hit the United Kingdom, okay? Cases are rising like nobody's business. So that actually, that actually caused the general public, the general market, okay, Main Street, to think that the Bank of England is unlikely going to hike interest rates, right? Given the worsening condition of the Omicron situation. So, yep, nonetheless, they actually did hike, okay? So because of these two main reasons, inflation and strong employment, okay? So other than this whole hike in inflation, hike in interest rates, okay, the central bank, let me just go down to the minutes, to the brief minutes, I would say 0.6p, I think. Apart from this hike in interest rate, the central bank actually, wait, let me just get the, oh my goodness, where is it? Economic projections. Okay, I think it's too lengthy to search right now, all right? But I'll just give you guys, okay, never mind. I think I'm not going to search it. Okay, I'm just going to read it out to you guys. So basically the BOE, okay, actually did some revision to their economic projections. All right. So for 2021 Q4, okay, at the moment, GDP expectation has been revised down by around 0.5%. Obviously, it's because of the whole Omicron impact and things like that. And Boris Johnson has just announced the Plan B for UK, okay, and encourages the workers, employees to actually work from home. Okay, hence a decline in economic activity in the UK is actually expected, right? So GDP expectation projection more or less has been revised downwards by the central bank. Okay, and the unemployment rate for Q4 2021 has been revised down, okay, from the projection from the November's 4.5% to 4%. This is actually good news, okay. Well, I mean, they have already seen from the data that the ending of the furlough scheme has little negative impact on the jobs market, okay, on the UK's jobs market. Hence, it's natural that the central bank will revise its unemployment rate expectation down. Okay, so more details on these economic projections will be provided when the central bank releases its monetary policy summary, I would say, a report, okay, monetary policy report. I think next time around in the February's meeting, right? That will be a lengthy report whereby we will know more about the other figures and probably the projection for 2022, 2023, and maybe 2024. All right. So we'll see how it goes during the next meeting. And they will be meeting in February, okay, February 2022, 3rd of February 2022, all right? So they're going to take a month off in January, okay? Good job, well done, Bailey, for the rate hike, okay? Any questions on this Bank of England surprise? Okay, you guys actually traded, well, not sure how many of you traded, but it actually went up and came back down, okay? Like pound yen actually went up by 100 pips, and then shortly after came back down by 100 pips. Like seriously, what's wrong with you, right? My take on this is that there's still some risk of sentiment going on because of the ongoing Omicron uncertainty, okay? And which is why we over here have been emphasizing that if you guys are trading news or even just trading normally, okay, just keep your trades short term, because you never know when this whole when there's going to be new updates on Omicron and things like that. All right. Okay. If there's no questions on Bank of England, I'm going to move on to the next central bank. Okay, the ECB, European Central Bank. Now, the European. Okay, great. For a moment, I thought my screen just froze again. For the European Central Bank, all right, they held monetary policy unchanged. Okay, interest rates remains unchanged. They do not have the luxury to increase interest rate at the moment. Okay, like the Bank of England. QE remains unchanged as well. But okay, there's some communication on what's life going to be like after the PPP ends. Okay, in March 2022. Okay, so what's going to happen? Over here, it says that in the first quarter of 2022, the Governing Council expects to conduct net assets purchases under the PEPP at a lower rate, aka tapering. But Lagarde probably just brush it off with, oh, this is not a tapering, this is just a monetary policy recalibration. Okay, whatever it is, all right. To us, if you guys are going to purchase bonds at a lower pace, at a lower rate, it's pretty much considered tapering. Okay, and it's pretty much good. Why is that the case? Because this shows that the economy does not require as much stimulus as before. Okay, does not require as much aid as before. Okay, in terms of support. So hence, it's a good thing, right? It will discontinue net asset purchases under the PPP at the end of March 2022. Okay, what this means is that the PPP will almost retire, okay, almost retire at the end of 2022. So when end of March 2022 comes, okay, the ECB will not be purchasing any more bonds, okay, under PPP, right? But they will still be purchasing from time to time, okay, because of this whole thing called the reinvestment, okay. The Governing Council decided to extend the reinvestment horizon for the PPP. Okay, it now intends to reinvest the principal payments from maturing securities purchased under the PPP until at least the end of 2024. Okay, previously I couldn't remember what is the agreed timeline for this whole reinvestment to end. Okay, but right now they have already extended until at least 2024. So this whole reinvestment thing, long story short, is this. Okay, bonds has this maturity timeline, right? When part of the bonds holdings by the central bank under the PPP program were to mature, okay, when they actually part of it matures, the central bank will actually purchase an equal amount or at least around that amount to actually replace whatever's been matured. Okay, so that's what they mean by reinvestment. Okay, so by doing so, they will continue to hold around the same amount of bonds, okay, or assets, which is to provide consistent aid to the economy, to provide consistent stimulus to the economy. Okay, so because if they were to not hold the same amount, as time passes, then it may create some movements in the market and things like that. Okay, and of course, it may actually have a negative impact on the economic recovery of the Eurozone area. All right, so naturally they will want to hold it, unchanged until they deemed that it's time to, to let go, to sell off part of their holdings slowly. Okay, then then okay, it's safe to do so. All right. So basically, that's what's going to happen for the PPP. Okay, it's going to continue to end in March 2022, and then you will enter this whole reinvestment phase. Okay, until at least end of 2024. Okay. Now PPP done. What's next? APP. Okay, remember the central bank actually has two parts to their QE: PPP and APP. So if they're not going to purchase any more bonds, okay, once the PPP ends in 2022, March 2022, what's next, right? You can't just end it and not have any repercussion, right? So what the central bank is going to do is they have decided on a monthly purchase pace of 40 billion euro in the second quarter. Okay, so at the moment, okay, the APP is running at a 20 billion euro per month kind of purchase. Okay, so once the PPP ends in March 2022, the governing council will increase this 20 billion euro to 40 billion euro in the second quarter. Okay, before slowing it down to 30 billion euro in the third quarter. Okay, and then from October 2022 onwards, which is the fourth quarter onwards, all right, they will cut it down further to 20 billion euros per month. Okay, this fourth quarter reduction to 20 billion euros per month will be for as long as necessary to reinforce the accommodative impact of its policy rates. So you guys may be wondering, what's the deal here? Like right now it's 20, and then in second quarter, you guys going to be increasing it to 40, and then cutting down to 30, and then to 20. Like, what's so good about it, right? Because the end of PPP program may actually cause an abrupt. It may actually be abrupt, right? So what the ECB is trying to do is to smoothen this transition, smoothen the exiting of the PPP. Okay, so which is why if they were to just end it like that, PPP, okay, and not do any amendments to APP or to come up with another new P, okay, purchase program, then the market will be like, okay, why is it that all of a sudden the Eurozone economy does not require as much stimulus as before? Okay, then well, Euro may really go up and down like 1,000 pips and things like that. Okay, so this is what the European Central Bank is trying to avoid: market chaos. Okay, which is why we let go of PPP, and then we will increase bond purchases from the APP. Okay, for 3 months. Okay, before toning it back down. Of course, the toning back down part, from second quarter onwards, it may actually be subject to change, okay, depending on how Omicron unfolds, how the Eurozone economy, requires support, monetary support from the central bank, okay. But as of now, the plan is to hike it up from 20 to 40, and then down to 30, and then down to 20, and then we'll see how it goes. So it's as good as reading off the PPP by next 2022 fourth quarter, okay, which is actually a good thing, right? What we want to do is to see them removing PPP and hopefully soon enough the APP, okay, because when they remove the APP, okay, it's a sign that the ECB will be considering an interest rate hike. Finally, okay, speaking about interest rate hike, Lagarde, okay, the president of ECB, actually mentioned during the press conference that it is highly unlikely that the ECB will be increasing interest rates in 2022. Okay, it's basically like no way are we going to hike it. Okay, so it's the dovish side of things. Okay, so at the moment, you guys are hearing good news coming out from the quantitative easing side of things, okay, which is ending of PPP. We're going to have this smooth transition over to APP, and then which is actually a good thing, okay. And then on the other side, the interest rate of things, we are unlikely going to see an interest rate hike in 2022. So this actually gives a bit of a mixed sentiment, okay, I would say mixed tone from the European Central Bank. A little bit hawkish, okay, from the QE side of things, and a little bit dovish from the interest rate side of things. So what do I think about this whole thing, right? You guys may be wondering. Personally, I would take it as a hawkish, a slightly more hawkish than previous, what do you call that? Previous meetings. Okay, yes, no doubt, we can expect no interest rate hike in 2022. But you must know that the Eurozone is not just one country. It's actually a combination, it's like a conglomerate kind of thing. It makes up like some 19, 20, 21 countries. Okay, so it's not going to be like, BOC, RBNZ and things like that, BOE even, just hike interest rate when they find that inflation is overwhelmingly high. Okay, not that the Eurozone's inflation is not rising, but they can't just do it like that, right? They have to take things very, very, very slowly, especially when it involves so many other countries. Okay, so personally, I feel that this is actually a good enough communication coming from the ECB, okay, especially when we know that we haven't been seeing a rate hike since I don't know when, like since forever, okay, and with the whole coronavirus hitting in March 2020, okay, the more we can expect no rate hike, okay, but then right now we are seeing a good progress in this whole quantitative easing, which may eventually lead to a rate hike. That is a good communication, I would say, coming from the ECB. Okay, so personally, I feel that the British pound and the euro may be actually, maybe taking up some strength, okay, in the short term. Okay, in the short term. Don't forget that the FOMC has been very hawkish as well. Okay, so if you guys are planning to trade pound dollar or euro dollar, just be careful. Personally, I would rather look for opportunities in cross pairs. Okay, cross pairs is probably easier. Like you may want to mix pound with the Australian dollar, okay, or maybe the New Zealand dollar. I mean, the New Zealand dollar is probably the weakest right now, if you would compare with the other major central banks, okay, because yes, they have been hiking interest rates, but they have taken a more conservative approach, a more prudent approach, okay. We want to play safe. We are not going to do an aggressive hike of 0.5, okay. We're just going to hike 0.25, take it one step at a time, okay. So, yep, pound dollar and euro dollar is likely going to strengthen, okay. And by the way, okay, the Bank of Japan probably be announcing their monetary policy like right now, or maybe they have already done it. But don't worry, nothing high impact is going to change, okay, during the meeting. I will just give you guys a brief walkthrough of what went down on the BOJ tomorrow. All right, and any more questions for ECB, BOE? I tell you, these two central banks it can get very complicated. All right. So if you guys don't have any questions now, if you guys have any questions later, just put it in the central bank, put it in the EcoFin platform, and I will just cover it with you guys. All right.
The Kim Hong Central Bank.
Oh yeah, I wish I have my own central bank, but that's not going to happen. Okay. So if there's no questions, I will hand it back to Scott.
All right, thanks for that, Gimme. And now to the US dollar. So, with the US dollar index, it definitely was, not the one really making, significant moves higher at all. So we did see it close under 96 as well. So this is the 4-hour time frame just with Sam Trade. I'll give it a zoom in and we'll go to the hourly and you can see how things sort of progress. So obviously we did have the spike to 97 with the FOMC release very early yesterday morning. And, as markets digested the situation, what was offered really was a little bit more certainty because, there had been a lot of this transitory language used by Jerome Powell, and we've seen that shift away from that. And I think that has helped calm markets. Now, we did obviously see the NASDAQ pull back around 2.4% last night in US trade. And, that really just says that, markets are now aware that interest rates are going up and people are looking to position away from, high growth companies, frankly, that rely on borrowed funds to continue to grow and eventually they become profitable. So that's why it's an interesting thing to sort of see when that starts cooling off. And then we see some inflows into gold actually got a lift as well. And we were saying, over 1789 or 88 in the coal yesterday for a potential buy trade. And we did see it nearly get to 1800 US an ounce. But for the US dollar, now, what I have been monitoring, and I brought up yesterday, is the 2-year US Treasury 2-year bond yield. I'll just share that screen now. I've noticed a little bit of a recent relationship develop here, and it seems to be strongly correlated. So just something I've been noticing. So we have this here now. Now, obviously, we had the spike up with the immediate news from very early in the morning on the 16th yesterday. We did see it shoot back down to sub 63, and now we're very sideways, and we're back, really, 63. If we go to the 3-month, you get a little bit of miscalibration when you actually go and see it, but you can see 68 was the high, but actually if you do go back down, you can see that is what it's doing currently. So something to pay attention to, and if we do get a lift, we might see that US dollar strengthen a little, but markets are sort of going with this understanding that there is a little bit more control there, instead of things being pushed, further and further down, to the next meeting, markets seem to be accepting this. And we did see some inflows into the Japanese yen instead of the US dollars. So from a short-term perspective, it's, something that, once the US session begins to start up, be interesting to see if we do see a perk up, or if we don't, then we just might see this US dollar steady out. Now, I do just want to go to the news as well from yesterday. A couple of interesting things that I noticed. So we'll bring that up now. And something that is probably worth talking about. So obviously there was a lot of news yesterday. A lot of news. And make sure you definitely catch the replay too of the callers for the Bank of England and ECB information. But what we did see was that if I go up, the Philadelphia Fed manufacturing survey came in way less than expected. And that was released at 9:30 last night, GMT +8. And I'll just bring up this tab here. So that was, a year low. So the last time we saw it below 15.4 on the index was back in, I think it was 2020. It was December 2020. So a year ago it was at 11. So it's definitely something to pay attention to, just to see what this does. Now, expectations were 30. 39 was the last month. We came in at 15.4. So, what this typically indicates is that, as you can see, significant slowdowns in the pace of growth in both new orders and shipments. So we are sort of seeing supply catch up a little bit now as things ease. And, obviously Omicron is, running, pretty hot in the UK, and expectations are that in the US with lower vaccination rates, that could be the same. So, that doesn't necessarily mean that it's a catastrophe, but it just slows down workforce participation. We sort of saw it getting close to that pre-COVID level. Now, what this just means for the US dollar is that I would say going into next week, markets start slowing down a little bit, because, most bigger players and institutions, start easing off for the holiday period. So that's something to pay attention to. With not a lot of big news events coming up, I would say that it might just hover around this 96. It's going to be tough to see it, the US dollar index move, beyond 96. 30 to 50 has been, especially 50 has been hard to break. And I would just say keep an eye on this maybe for next month, and just see if there is a lift. And, we're going to a few more weeks now of seeing what Omicron is doing. So I would say that just maybe pay attention to the currency pairs that have got a little bit more news around them and a catalyst, because it looks like the US dollar is just sort of losing that appeal with the inflows for, the safe haven currency that it offers. So I guess more time to tell if this is just a bit of a blip, and if, the pullback's bought, or if we do see, just interest waning on the US dollar. But we do have the USD CAD in focus now with Jin, and then crypto to finish up. So over to you now, Jin.
Thanks for that, Scotty. And out of everything that has happened, we've seen the Bank of England, we've seen the ECB, we've seen the FOMC, it looks like the US CAD has been the most somewhat well behaved and the quietest over this period of time. With that, just showing you the charts here to start. The US CAD on H4 time frame started off the week at about 1.2747, tracked up towards that 1.2926. I think Traders Club members, if you remember, we were talking about this on Monday night, where we were looking at this 1.2926 level. I think I went to the daily time frame and you can see that it tested back in August this year, rejected it straight away. It came very close in September, rejected that straight away, and now we've seen it again in December, and it seems like the big rejection on the price action. Looking at the candlesticks, we see that big pin bar testing and rejecting that 1.2926 level. This is on a daily time frame. So coming back to the H4 now, it is at the 1.2796 level. What could happen? Looking at the news here on the economic calendar, you notice that today being Friday, end of the week, not a lot of news to be released, especially in particular to the US CAD. We do have some news there, but not big price movers. I think we're going to see a little bit more of a consolidation throughout the day before some short-term volatility towards the end of the day, as people might be offsetting their accounts, closing off trades, closing off accounts towards the end of the week and also towards the end of the year, because I think from next week onwards, we're going to see that lower volatility. We're going to see a bit less volume being traded because we are into Christmas week and then after that into New Year's week of the New Year's Eve. So looking at that, what else could happen into next week? The only thing I would pay a little bit more attention to is Tuesday. Tuesday night, we do have the retail sales, core retail sales number and the retail sales number coming from the CAD. At this point, looking to go from a minus 0.6 to a minus 1.7. So not strong retail sales numbers to be expected. And then on Wednesday, we have some news from the UK and from the US. Following from that, a GDP number coming on Thursday, month-on-month GDP, probably not a big change. And even if there might be a change, we're not looking at any volatility or big volatility because it is on the 23rd of December with holidays to follow from there. So what should you be looking for at this point? Coming back to the charts, what you should be looking for is not a lot of trades. I would anticipate that it's going to bounce off this, or it looks like it's bouncing off already. It's bouncing off this 1.2747 level. It might be nice. It would be nice to see it track up back towards that 1.2926. Most likely move about a 50 pip stop loss for a 100 pip take profit level towards the upside. I think that will be likely. No, that could happen, but a bit unlikely. Or because of the daily time frame, we could be looking for it to break that 1.2747 to head lower back into the 1.2618 range. At this point, I think because of that lack of economic drivers, because of the possibility of lower volatility and lower volume, not a lot of trades to be expected here for the US CAD. I think that although it can go up towards that resistance or break that support to the 1.2618, most likely scenario is we're going to see it sit in that range. We're going to sit in that range for today into next week before possibly bouncing back up slightly, maybe not that much, slightly because of the retail sales number expected for the CAD. So don't do anything now. Wait till next week on Tuesday. You might be looking at a above 1.2777, 40 pip stop loss, 80 pip take profit level. I think that would be it for the year for the US CAD. With that, I'll pass it back to you, Scott.
All right, thanks for that, Jin. And just to finish up, guys, we will go through crypto here as well. So specifically, that will be Bitcoin and Ethereum. And just going through things just now, and I will have that series of trade ideas posted as well for USD CAD. Not really a lot here to offer from Bitcoin. It, again, fails to sort of move higher off that 47,000 level. And just going through, a few contacts that I have that, monitor Bitcoin and Ethereum a little bit closer than I do from a intraday perspective. Now, obviously there are opportunities intraday, but really I think 40 has to sort of get revisited. Now, people do talk about Bitcoin and Ethereum and crypto being used as an inflation hedge, but I think it leans more towards being, treated as just a growth stock nearly. So when interest rates are higher, people are going to take care of the more important things, and that's probably not the crypto portfolio. Obviously, some people will continue to add, but you'll see that if institutions are holding and things of that nature, they will have to protect their clients. And the downside is more what I'm looking for. And then buying opportunities, firstly at 40,000, and then we'll see if 40 breaks, then it's 28 to 29, which is ambitious, but that would be how I would approach that. So especially in the lead up now to the holiday period, it's just tough to call this, a nice dip buy opportunity. I would say it's very aggressive, and more selling is looking likely for Bitcoin. Now, Ethereum, interesting. So it has dipped down below into the 3.7s and 3.6s. That's USD per Ethereum. And, it's hovering around 4,000. Does seem to be showing a little bit more resiliency. And when it comes to the risk to reward, the buy trade's still a tough one. And so again, I've got 2,800 here. Is 3,200 is also, I haven't got that in. I really prefer 2,800 as a more conservative buying price, and it's just going to take some time really. So maybe after Christmas we might see people really realize what's going on with their finances once things are settled, and you can see that in January sometimes. Some selling does take place after what they call the Santa rally. But for, crypto, we haven't really seen that. So, for Ethereum as well, no immediate trade idea, looking at, 2,800 or so, which could take a little while to get down, but just sort of more of a cautious approach with both of those. But I'll make sure I do share those in the crypto chat as well, and the CAD trade ideas for next week's retail sales are coming out as well. Just want to check the chat as well. No questions. Hope everyone has a great weekend as well. We'll be around as well in the chat, guys, if you do have anything to share or talk about or questions. And thanks again for joining us this week, and hope everyone has a lovely rest of the day. Thanks for watching, everyone.